Well, thank you very much, Jeannie, and good morning, everyone. My name is Jon Schreibfeder. I'm president of a company called Effective Inventory Management. All we do is help distributors, manufacturers, large retailers get the most out of their investment in stock inventory. We try to help you accomplish what we call the goal of effective inventory management, and you see that on your screen right now. What I think you're trying to do with inventory is, first of all, to meet or exceed your customers' expectations of product availability. I want to stop right there. If you don't do that, you're going to be out of business. You have to have the inventory in your warehouse, in your store, in your facility that's going to meet or exceed your customers' expectations of product availability. But we want to do that with the amount of each item that is either going to maximize your net profits or, especially in today's challenging economic climate, minimize your inventory investment. A lot of people today want to reduce their inventory, improve their cash flow. Others are trying to buy the amount of each product that's going to maximize their net profit. Okay? You may be able to buy a larger quantity and increase your profitability. But whether you're trying to maximize your net profits or minimize your inventory investment, there are several fairly easy things you can do to achieve this goal. In these next 3 webinars, we're going to lead you through the process to accomplish the goal that you see. Now, if this goal is so easy, why do people suffer? Why do people experience these very common problems? Too many stockouts of products that are supposed to be available for immediate delivery. Not having what your customers expect you to have available on the shelf. Oftentimes, we see distributors that are experiencing many stockouts, but at the same time, they have excess inventory, dead stock of other products. They have too much of the wrong item. Hey, today, in our economic environment, there is so much pressure on you, in all probability, to save cash, to minimize your purchases. We've got to overcome these and other obstacles. We're going to start today on a program to do this. The first thing I want you to do is define what your customers expect you to have in stock. Remember, I said the goal was to meet or exceed your customers' expectations of product availability? Well, you have to know what they expect. I would predict that in your warehouse right now, you have 2 things. We call them stock and stuff. Stock is, as I say, the merchandise you intend to stock, what your customers expect you to have to meet or exceed their expectations. Stuff is everything else. Material that inadvertently got stuck in your warehouse. It's dead. It's not needed. We have to separate it from the good stuff, your stock, and get rid of it to free up some cash, or I should say generate some cash, and also to make room for your good inventory. Well, how do we separate your stock from your stuff? I would suggest to you start by looking at how often your customers request a product. As I say on this slide, the more often a product is requested, I would suggest you the more reason you have to keep that product on the shelf in stock. We look at hits, okay? A hit is a request for a product regardless of the actual quantity ordered. If a customer calls you and asks for 1, 10, or 1,000 of the product, it is 1 hit. Again, the more times they request it, I would say the more reason you have to keep it on the shelf. As an example, look at the 3 items on this slide, the A100, the B200, and the C300. Okay? The A100 has a lot of sales in dollars, $300,000 worth in the past 12 months. But if you look over towards the left, we have 2 hits. We've only sold it twice in 12 months. I would like to make this a special order item if I possibly can. I don't want it sitting in my warehouse gathering dust just to be sold once or twice a year. Compare this to that third item, the C300. Okay, low sales in dollars, only $6,500 a year, but we've sold it 50 times, about once a week. I would suggest to you that this is a product that we want to stock. So we're going to rank products. And many computer systems rank products. And what we do is we sort products when we rank in descending order. On this slide, I'm sorting the products in descending order by cost of goods sold, that middle column, 12 months cost of goods sold dollars. See the top item, the product 8201, well, that had sales of over $531,000 last year. It is an A item based on cost of goods sold. You see that over towards the right. One of the things that frustrates me about many computer systems is they only rank products based on cost of goods sold, dollars moving through inventory. If we go back to the previous slide, that A100 would be an A item. But as I said, in deciding what to stock, you want to pay particular attention to how often the product is requested. When we did a separate ranking for these items, the product 8201, the one at the top, actually had a B rank. It wasn't requested as often as many other items. It is imperative that when you organize your inventory, you not only look at a cost of goods sold ranking, but you also look at a hits ranking. Okay? Now, some computer systems don't accurately record hits, the number of times a product is sold. But if your computer system doesn't do this, don't worry about it. You can easily scan your inventory with a report generator or download your data into an Excel worksheet, an Excel spreadsheet, and look at the number of times, the number of months, I should say, the number of months within the past 12-month period a particular item has had usage, the number of months in which an item has been sold. This particular product, we sold 50 in December, 20 in June, 50 back in March. We had usage in 3 of the past 12 months. Would you stock this item? Well, it's a very subjective decision. I would suggest that you look at all items that have had usage in 3 or fewer of the past 12 months and decide if you want to keep them on your approved stock list. Now, I said we need to rank products not only by activity or months with usage, but also by cost of goods sold. And in doing this, we can form what we call a double rank. Okay? You have some items that are what we call AA items. You see those in orange on your screen. What are AA items? Well, they are high cost, high activity items. They cost a lot and people request them continually. The AA items are the products your buyers have to micromanage. They are walking on a tightrope. They can't be out of them because customers are always asking for them. On the other hand, you don't want to have a large investment in these products. You don't want to overstock them because they're very expensive. I like my buyers to look at AA items at least twice a week just to monitor their stock levels, how they're being sold. You have some DA items. You see those in green. What are they? Well, they're high hit, high activity. You have a lot of requests for these products, but at the same time, they're D-ranked based on cost of goods sold. They're very cheap, very inexpensive. These are the products I'm not that worried about because if I overstock them, I haven't put a lot of money in my warehouse because they're very cheap. But what I'm particularly interested in is the AD items. You see those in red in the top right-hand corner. Those are very high-cost items. They are A ranked based on cost of goods sold, okay? But low activity, D ranked based on hits. Those are the first ones I want to ask my salespeople, do we really need to have them in stock? Can I make these special order items? They're very expensive. We don't sell them that often. Do we have to have them to maintain good customer service? Do customers realistically expect these items, as well as all of my C, D, and X items, to be available for immediate delivery? C, D, and X items usually account for the last 5% of product requests. These are the items typically that will be requested 3 or fewer times each year. Is one of these items a critical item that must be stocked in case of emergency? Can a more popular item be sold in place of this slow-moving product? Do you have products in your warehouse right now that are different brands of exactly the same item? Do you have products that can be easily substituted for one another? If you do, you have products in your warehouse that are competing for the same sale. I would suggest to you that you have enough competition outside of your company to put up with competition within your own warehouse. 2 products competing for the same sale. Discontinue slow-moving items if you can, if you have a similar item with more activity that can be sold in place. Now, the items that you see, the questions that you see on this screen are very, very, very subjective. There is no right or wrong answer. I want to take this subjective question as to whether we should stock or not stock a product and turn it into an objective question. In the next few minutes, I want you to know definitively whether or not you should stock a product. I want to separate your inventory into 3 categories. We call them the good, the bad, and the ugly. Good inventory is what you make money on. Making money is good. I say here, it provides an acceptable return on your investment. Bad inventory. Well, you lose money on it, but it contributes to other profitable sales. It is a necessary evil. You wish you could get rid of it, but you probably heard, if I didn't carry this, I couldn't sell that. Okay, so this is bad inventory. Ugly inventory. Anything that isn't good or bad. I lose money on it, and it doesn't contribute to any other profitable sale. I want you to get rid of your ugly inventory. Well, how do I separate the good from the bad from the ugly? Well, one way I know I can't do it is by looking at gross margins. Gross margins are meaningless. What did he say? I'll say it again. Gross margins are meaningless. The most overused, overworked business metric in history. How can I say that? You know your gross margins. You're running your business on your gross margins. How can I say they're meaningless? Well, look at this item. I had sales of $10,000 last year. Cost of goods sold was $6,000, which means I made $4,000 profit. $4,000 profit, $10,000 in sales. That's a 40% gross margin. A lot of you would say, that's great. I'd love to have a 40% gross margin. But I have $12,000 in inventory. Okay? Cost of goods sold of $6,000 a year, $12,000 in inventory. That is 1/2 of 1 turn a year. I'd have the same gross margin if I had $1,000 in inventory. I would have exactly the same gross margin if I had $1 billion in inventory. Why? You don't see inventory in that gross margin equation. Okay. I want you to abandon gross margin. If you pay commissions on gross margin, you are encouraging your salespeople to beat up your buyers to get the lowest possible unit cost even if they have to buy an extraordinary amount of a product. Replace your gross margin with a better measurement that we call adjusted margin. Similar to gross margin in that we are dividing profit dollars by sales dollars, but from the profit dollars we are subtracting your cost of carrying the average inventory investment in an item. What it costs to you incur when you carry inventory in your warehouse? Well, you incur the cost of putting away stock receipts, moving material within the warehouse, insurance, other charges on your inventory, rent utilities for the portion of your warehouse used to store material, shrinkage, obsolescence. If I don't buy it, you can't steal it from me. Physical inventory, cycle counting. If you don't buy it, you don't have to count it. Finally, the cost of the money invested in inventory. It is critical. It is critical that you know what it costs you to maintain inventory in your warehouse. How much money does it cost you to maintain $1 worth of inventory in your warehouse for an entire year? If you go to our website, www.effectiveinventory.com, you will see a button, the third one from the bottom, entitled Carrying Cost. Go to the website, hit that button. You will see a questionnaire. Fill it out, send it to us. We will calculate your cost of carrying inventory for you and tell you if it's high, low, or just right for someone in your industry in your geographic region. Typically, in California right now, carrying costs range from 17% to 23%. That means it costs you somewhere between 17 cents and 23 cents to maintain $1 worth of inventory in your warehouse for an entire year. But you have to know what it is for your firm. Now, in the example that I'm showing you here, I'm using a carrying cost, which is also called a K cost. Why, I have no idea, but it is. I'm using a carrying cost of 20%. Look at how, as the average inventory goes from 250 on top to 500 to 750, the adjusted margin drops from 10 to 5 to 0%, even though the gross margin remains constant because I'm making $150 gross profit on $1,000 in sales. Okay? Now, this is wonderful, working with adjusted margin, but the adjusted margin alone doesn't tell us if we're looking at good, bad, or ugly inventory. We need to compare that to something, and it's something that I call the NIREP, the non-inventory related expense percentage. I developed it. I can call it anything I want to. I call it the NIREP. Okay. We take all of your non-inventory related expenses divided by total annual sales. This is an overhead expense without inventory costs. Now, you might say, this looks very, very difficult. How am I going to come up with what my annual non-inventory related expenses are? It's not difficult. It is, in fact, very easy. When you fill out that carrying cost questionnaire, you will use a general ledger report out of your computer system. Some of you know it as a profit and loss statement. Others will call it an income statement. That general ledger report has 3 sections: income or sales up on top, then all of your expenses, and hopefully down at the bottom you see some net profits. We want to focus on the middle, the expenses. Every expense can be classified as either inventory related or non-inventory related. If you use an expense filling out that carrying cost questionnaire, if it falls into one of those categories that you see on slide 18, it is an inventory related expense. So if you fill out the questionnaire, just mark off those expenses. Everything left over is a non-inventory related expense. We take the non-inventory related expenses, the total for the year, divided by your total annual sales to get your NIREP. Okay? Now, we can do some comparisons. If your adjusted margin is greater than that NIREP, you're looking at good inventory. You are making money. Making money is good. Okay? To put another way, if your profits minus the cost of carrying inventory exceed your other expenses, you're making money. But if the opposite is true, if your profit dollars, your gross profit dollars, minus the cost of carrying inventory, if that is less than your other expenses, you're losing money. You're looking at bad or ugly inventory. It's bad if we're losing money, but we can combine that item with other complementary items, and the combined adjusted margin is greater than the NIREP. Let's look at the example of that. The right, I have an item I'm losing money on. It's bad or it's ugly. Okay? I have $500 in sales. The material cost me $400. My average inventory is $500, probably because the vendor is only going to sell me a large quantity of the product. I'm losing money on that dog. I want to get rid of it. But the salesman says, you can't because I need it to support the rest of the product line. So I see the results, the adjusted margin of the rest of the product line. If you look on the left-hand side, I have sales of $50,000, cost of goods sold of $42,500. I'm making $7,500 gross profit. Okay? Average inventory $5,000. My carrying cost 20%. So I combine the numbers. The gross profit, $7,500 plus 100 is, you can see on the bottom, $7,600. Minus the carrying cost of all the inventory, the $5,000 plus 500 is $5,500, divided by total sales of $50,500. That is an adjusted margin, combined adjusted margin of 12.9%. Now I said a typical carrying cost is 17 to 23%. A typical NIREP, somewhere between 7 and 9%. This is above that. That bad item is truly bad over on the right. Okay? I'm losing money on that, but the entire line is strong enough to support it. Let's say it wasn't. Say I had an adjusted margin that was 4%, 3%, 0%, maybe even negative. I want to get rid of this item. But my salesman saying, no, if I didn't have that product, I'd lose a particular customer's business. Okay, this customer gives us $100,000 in sales every year. We make $15,000 profit. That means I'm making a 15% margin, gross margin, $15,000 divided by 100. Well, if I were maintaining $50,000 in stock of inventory for this one customer, and my carrying cost was, say, 21% a year, well, that $15,000 gross profit really doesn't translate into a 15% gross margin. I'm going to subtract the cost of carrying all of that $50,000 worth of customer-specific inventory from that $15,000, and I'm going to land up with an adjusted margin of 4.5%. Okay? In this example, 4.5%, I said a typical NIREP was somewhere between 7 and 9%. That's my overhead cost, somewhere between 7 and 9%. This is less than that. I'm losing money on this customer. I had better increase my profit dollars from this customer or lower that $50,000 inventory investment I have in customer-specific inventory. If you do this, if you run this adjusted margin, you will determine what products in your inventory are making money, what products contribute to other profitable sales. Everything else, get rid of. Now, one of the other things you need to do initially to improve your inventory management is determine how well you're forecasting, how well you're predicting what you are going to sell in the future. I want you to ask yourself 6 questions. Who in your organization is responsible for predicting what you're going to sell? What method are you using? What do you consider? What factors? Just past usage? Are you considering collaborative information from your customers or your salespeople? How often do you forecast? You should all be forecasting every item at least once a month. How far into the future do you have to forecast? If you're importing products from Asia, you may have to forecast 3, 4, 5 months into the future. Why? Because you have long lead times, and if you order today, you might not receive that material before November. If you're going to receive material in November, knowing what you're going to sell in August and September does you absolutely no good. Historically, how accurate have your forecasts been? And I love to look at this because, on average, most people do a horrible job of forecasting. I want you to calculate your forecast error, particularly on your fast-moving products. We use the equation, taking the absolute value of usage minus the forecast. If you remember from grammar school, absolute values are always positive. We divide that by the lower of the forecast, or usage. Okay? So if we have usage of 100 in October, a forecast of 50, that turns out to be an error of 100%. 100 minus 50 is 50, divided by 50 is 100%. Get the same error if we reverse those numbers. Being overstocked is as bad as being understocked. Okay, I want to minimize that forecast error. If you can get that forecast error down, and I want you all to have it down below, say, 35%, you're going to be a best practice distributor. We did a study for the National Association of Wholesale Distributors a few years ago. We found that most distributors did a horrible job of forecasting. The mean forecast error was 682%. Average forecast was 682% off. The one in the middle, the median, was 381% off. But best practice distributors have forecast errors about 1/10 of those average. They all have forecast errors under 35%. Because the better you forecast, the less you need to stock to maintain your desired level of customer service. You can be very successful. With good forecasting, we have reduced inventories. Last year, we reduced them an average of 32.5% based on volume. How can you improve your forecast? Well, get over these common forecasting problems. The if it's on paper, it must be true syndrome. Believing what your system says to be the forecast. Most systems based forecasts solely on some average of past usage. Buyers, planners don't know the formula. Most systems don't verify the formula to see how accurate it is, help you improve the formula. Most distributors don't have a system in place for obtaining and checking the reliability of information from customers and salespeople. Okay? Also, they don't take advantage of what we call dependent demand, when customers can tell you in advance what their needs are going to be. In those situations, you need to get that information from your customers. When they can give that information to you, you can make better buying decisions. But in order to improve your forecast, one of the simplest things you can do is bring possible unusual usage situations to your salespeople. Ask them what's going on. And we're going to look at 2 examples. Salespeople are closest to the customer. Salespeople can best determine if possible unusual activity is truly unusual, it's activity that will not reoccur, or it isn't unusual. You're looking at the start of a new trend, whether it is higher or lower sales. Look at this item. We've been selling, 303 in January, 450 in February, March 375, 290 in April, 410 in May. We sold 1,500 in June. Now, we predicted that we'd only sell 368 in June. We actually sold 1,500. We predicted we'd sell 368. What happened in June? I need to find out. Was this one unusual sale, or am I going to have a customer who's going to be buying this item in large quantities in the future? Same thing. If I see a sudden drop in demand, we went from 210 units sold in May for this item, down to 40 in June. Okay? We had predicted that we'd sell 224 in June. We only sold 40. Again, what's going on? Is this a temporary decrease in sales, or is this the start of a new trend? Has demand for this product just fallen off of the face of the earth? How do we know? We ask your salespeople. Salespeople should go out to the customers and ask them what's going on. If that one sale of 1,000 pieces, when we sold that 1,500, is unusual, you need to definitively back that out of your sales or usage history. You can't forecast with that information or you'll be overstocked. We always use in forecasting what we call net or override usage. What is true usage minus any adjustments. And here we're backing out that 1,000 pieces because it's a one-time only sale. Now this next slide may be a little confusing. If we sold 1,500 in June and our customer says, yes, I'm going to keep using this item in large quantities, best practice is to go back into your computer system and adjust usage up by 1,000 pieces for each of the previous 12 months. We do this to, you might even say, trick your computer system into believing this customer had been buying this product in this quantity all along. If you do this, no matter what forecasting methodology your system employs, you will have enough inventory for your previous customers plus this new customer demand as well. Well, I want to take just one more subject for you right now, and that is new stock items, deciding when to bring in a new item. I was visiting a distributor, let's see, today's Friday, it was Tuesday of this week, in New Jersey. I asked them, Robert, how do you decide to bring in a new item? And he said, well, the salesman for my vendor calls me. If it's a good idea, I say, send me a couple cases. Send me a couple of cases. I looked in Robert's warehouse. His warehouse was filled with a couple of cases of this, a couple of cases of that. He didn't have a plan in place for bringing in new items. I want you to have a structured approach to bring in new items. When you consider bringing in new items, you are making a commitment of company resources. Most people take this very lightly. As a result, they don't sell through the initial quantity they bring in. They may bring in a carton of 48. They sell 20, and 28 die in their warehouse. I want to remove that dead inventory from your warehouse. In fact, I never wanted to get into your warehouse. When you consider what you're going to stock a new item, you need to consider previous usage of similar items, usage of this item in other warehouses if you are a multi-warehouse company, vendor and market forecast, salesperson predictions, customer commitments. I want you to fill out what we call a new item questionnaire. 7 questions. Who's going to buy this product? What are they willing to pay for it? Why are they going to buy the product from us is the second question. How much of the product will be sold in each of the first 6 months? Okay? Why do I say each of the first 6 months? Because typically a new item will have a usage pattern where it will come in, have a lot of sales, then sales will fall into a normal pattern. That's the diagram of a successful new item. So you're going to see a spurt in activity in most cases 4 to 8 weeks after introduction. What effect will this item have on sales of other products that we stock? I don't want to bring in a new item that's going to take away half the sales of an existing item and still stock that existing item the way I did before. I want to cut my inventory of it. How much do I have to invest in this new item? Do we have space in our warehouse to store this new product? If this new product doesn't sell as we anticipate, can we return it to the vendor and get our money back? Can we liquidate it in any way and at least recoup our investment? I want these questions answered with someone's name at the top of the questionnaire. And this questionnaire is going to go to a product committee, a new product committee. And the magic number is 3. 3 people in management. They can be in sales, marketing, buyers, general management. And we found that if 3 people look at a questionnaire and say, this is a good idea, bring this product in, the chances of that product dying in your warehouse, you not selling through the initial quantity you bring in, very low, under 10%. But if one person makes a decision on their own, chance of that item dying is astronomical, over 75%. 75% of the time, you won't sell the entire initial quantity you bring in. You'll also find that some people in your warehouse are better predictors of what you're going to sell as far as new products is concerned than other folks in your warehouse. You want to rely on these people. Put more faith in their prediction. Okay. We've covered a lot in the past 40 minutes, but I want you to start the process of achieving effective inventory management by developing an approved stock list for each warehouse. Get rid of your gross margin analysis. It's going to lead you astray. Adopt adjusted margin, as we just saw. Okay? Analyze possible unusual usage. Improve the accuracy of your usage or sales history. Take out the high and low spikes. Use a system that offers you several ways to forecast. Find the forecast formula that minimizes the forecast error. And finally, implement a new product questionnaire. That should keep you busy for the next few weeks until we get together again. And starting this process will begin the path to the goal of effective inventory management. By just starting with these things, you will see improvement. And as always, if you do have questions, please let me know. There is my contact information. You can also contact us through our host Apex Computer Systems. I want to thank you, and I especially want to thank Apex for sponsoring this webinar today. And with that, Jeannie, I'm going to turn it back over to you.